Welcome back, traders, to another episode of the Refined Q&A podcast, where we talk everything no-nonsense Forex related plus more, coming to you each and every weekend. My name is Dillon, and I am, of course, joined by Judge. So today's video is actually a very important one, actually one of the most important ones that we have to date, and that is talking about volume and as well as the one candle rule. Now, why this is so important, of course, we go into detail throughout the podcast, but particularly when it comes to volume and finding the right volume indicators, this is actually very, very important, and it has the biggest impact to your trading strategy and your algo development. You will find when developing your trading strategy that volume matters, particularly as trend traders. There has not once been a trend where there has been no volume. So that is where volume and finding the right volume indicator to get you into those trends is very, very important. We also mention why volume, particularly in the Forex world, is much different to other markets, just like the stock market or even other commodity markets. And that's because it is not a centralized exchange. Because Forex, the way it works is it is scattered across the world, and there is different brokers all trying to do the same thing. Measuring volume can be sometimes very, very difficult. And that is why, as Forex traders, we really need to understand how volume works in this particular market. We then transition to the one candle rule and why the one candle rule affects our trading algorithm. And we also clarify one common misconception that is within the no-nonsense Forex community in regards to the one candle rule. But because it is very, very common, some of you, I would suspect, might be a little bit shocked if you are incorporating that one candle rule nuance. And of course, as always, we then transition to the questions for this particular episode. Now, we did cover a lot in this episode, and there were very few questions, particularly related to volume and the one candle rule during the live stream. However, I think that's because volume and the one candle rule as well, they may be hard to get our heads around, and it might be the case that we don't know what we don't know. So if you do listen to this podcast and you do have any questions that do arise from this podcast, then of course there's nothing stopping you from reaching out and actually popping those questions into the chat function within the Discord or through the YouTube channel. And of course we can then attend to those questions in future videos to clarify anything that we did miss. One final thing that I just want to quickly mention is that for the next week's episode, we are going to be talking about build order for our trading strategies. So it is a little bit of a break from the actual no-nonsense Forex trading algorithm, which I think is really good. And because we've already started talking about some of the elements within our trading algorithm, the question has come up already. So that is going to be next week's episode. So if you got any questions in relation to build order, feel free to pop them in. With all that being said, we do hope that you enjoy this video. If you did get a lot of value out of it, then we would appreciate if you could share this around to some of the other no-nonsense Forex traders that you do know, because it might help answer some of the questions that they might have as well. So we hope you enjoy this one, and let's get straight into it. Through the no-nonsense Forex Discord. So we're going to be talking to that too. Judge, is there anything you want to add?
I think this episode is going to be pretty explosive, maybe. There'll be some great gems and epiphanies coming out of it, especially because volume, as you said, is one of the harder indicators to find or harder pieces, I should say, in this no-nonsense Forex trading method. We're going to talk about how to tune it, what to look for, what the different types of volume indicators are, and the reason why we've chosen the next part, which is the one candle rule, is because it is specifically related to volume, and it is the first nuance in the no-nonsense Forex system. We're going to touch on, I suppose, a little bit about what nuances are, but this one is obviously specifically to do with volume and how it affects your C1 indicator signals. So it'll be great. It's going to be a good episode. I'm looking forward to it.
Very good. Of course, we all know the drill. Judge, I'm going to keep you on there for a little bit. How's the trading going for the week?
Yes, I totally forgot about this segment. This week has been. I think everyone can attest to this. Everyone that's forward testing or live trading the no nonsense forex way. This week has been a very interesting week globally. So you would have noticed it in the markets. It's been whipsawing quite a bit. I've certainly hit a few stops due to that volume rising and the ATR adjusting. The trends aren't quite there, but the volume has returned. It was starting to rise. EVZ sort of broke for a couple of days, but it's been rising. It's now mid sixes, is still trending upwards. If you pretty much look at the news of the world currently, you've got oil crises in the United States that I'm sure all our US viewers listeners know about. But then you've got all the tensions and whatnot happening over in the Middle East. You've got obviously the standard China pressures and everything that's happening out of Russia as well. So it's heating up. And what does that mean for no nonsense for us? Because obviously I'm not being political here, but what does that mean for us? Well, it means that people are starting to get a little bit antsy. That's why the EVZ is rising. That is why this is perfect trend weather coming. So if you're getting a little bit beaten up right now in the markets, don't stress. This is to be expected. Just continue to trade your system and stay the fuck out of the way. It's as simple as that. I've been doing the same thing, and it's been a little bit rough in the last week, to be honest. But yeah, you would just stay in it, and should be some good times ahead, in my opinion.
Yeah, I'm definitely on the same boat, Judge. I've noticed the same thing. I've had a few signals this week, and of course, trying to be the disciplined trader that I hope to be, staying out of the way and actually trading your trading strategy is so important. So although I did hit as well a couple of stop losses, I'm still in that same trending trade that I've been talking about for the past couple of weeks, which has been pretty good for myself. Yeah, so it hasn't seen the volatility that some of the other pairs have seen, and thinking about what's happening geopolitically and everything around the world, and some things, majority of them aren't good, of course. Well, all of them aren't good, unfortunately. I think the current pair that I'm in is outside of that. So that's where it hasn't seen as much volatility compared to some of the other trades that I have been in, and it's been whipsawing around. And unfortunately, some of them did stop out, or I did get broken even. But at the end of the day, what's important is trading your strategy, staying out of the way, and being the disciplined trader that you are. Because if you've tested your trading strategy properly and you've back tested it, forward tested it, and you have confidence in it moving forward, then there should be no reason for you to deviate from your trading strategy later on. And I think that's what Judge mentioned. It's very, very important to be doing that. So more or less the same.
Yeah,
so it's good to see volume.
Some faith.
Yeah, that's
have
right.
Have some faith. These are just times. These are actually, if you think about it, it's 5 candles in the last week. Yeah. we're all hurting a little bit, but 5 candles in your 3 or 5 or 10-year back test is really insignificant in a period of time.
That's right.
And I mean, I think we were talking about this as well, Dillon, a week or so ago, about some of the US news events which have been coming out have been really high impact. And I think through the Trump era, the red news events of old, that especially a lot of the ones, the high impact ones VP had spoken about, a lot of them were not doing anything. But ever since recently, a lot of the US news events are really high impact, that they actually hurt, making the market heave. And that's a good thing because, trends come out of that. And so we're just waiting to see when they actually start to come off, because I'm confident we'll get a mega trend very soon with the way that things are going. But it's just, I think, we were talking about this a week ago where NFP came out last Friday.
Yeah.
And it was like a massive candle within an hour. It was like 150 odd pips, I think, on a lot of the US pairs. But I was reading a few days later that apparently that NFP was the first forecast in 20 years that was so far off. Like, they got it so wrong. They had no idea, because a lot of the time happens. This sort of data comes out, it filters out, trickles out.
And there's expectations, and then it gets priced in. But
but this one they got so wrong that it just fucking heave the market. So, this is happening with a lot of the, the CPI that came out in the last week as well. Retail sales came out as well. They're all actually moving the market. And I think that's a good thing for us.
Yeah, that's right. I think there is a lot more attention now, especially of late, going back into the Forex market, which is why previous years it was a little bit slower and there wasn't that much volume for majority of the years. But by the looks of it, and because people are more aware of what's happening around the world, I think there is a lot of attention that is going back into the Forex market, which is really good for, of course, us being trend traders. And I think what a better week, Judge, to talk about volume, because I mean, we've already started talking about it in our trading for the week. I think what a better time and a good segue to talk about volume. I think we planned that one quite well, I have to admit. So, Judge, I know you've got a little bit to say about what volume is, particularly in Forex, and how does that differ to volume, particularly in other markets? Because I know if you came from other markets, volume would be measured, I guess, I'm talking about the stock market and things like that. Volume would be very consistent and measured, I guess, easily across those markets because they are centralized. But because Forex is not a centralized market, this is where to measure volume can be sometimes very difficult. So, Judge, did you want to talk about volume in Forex and why it's different?
Definitely we need to cover this just so that we have everyone on the same page. And I know VP covers it, quite high level in his podcast on it. But essentially, the one thing to remember, and this is one of the things that makes No Nonsense Forex so unique, was VP came out, with the big banks video, and he said, how large institutions move the market. And it's not, bulls versus bears so much that, retail traders moving the market. And the reason I'm touching on that is because that belief that it's people moving the market, that comes from other markets like stocks, ETFs, anything that's supply versus demand. Those sort of markets are all moved by individual transactions from individual traders. So stocks, indices, crypto, all those markets are supply and demand. So due to that, you can measure volume quite easy because it's quite centralized because there's a market out there for individual assets, for individual orders, and you can count them all. Because, for example, the ASX in Australia, which is our stock exchange over here, if you didn't know, it's centralized. If you go to a stock or a particular company, it has a limited number of shares. For that particular company to increase its number of shares or its market capitalization or and essentially its liquidity, they have to go through a mass process to do that. For example, had ownership of some shares in a company, you had 100 shares in that company or so, you can't convert those 100 shares into 100 shares in a different company because you actually own a piece of that company. Whereas in Forex, it's different because it's a currency and there's two currencies involved. And because it's currencies and it's all over the world, there's no centralized exchange that counts all the orders. So when it comes to volume, there's no real way of measuring it because there's an infinite amount of money at the end of the day. It's not a limited amount of shares in a particular stock. So if there's an infinite amount of money and governments can destroy money and they can print money, they can do both. And there's no process for them doing it. Their central banks can, add a shitload of money. They can remove a lot of money, when debt gets paid down. And so that the actual supply of the Forex market is ever changing all the time. Not to withstand that leverage is in there as well, and they're printing money and then, loaning it out and creating more money. And then they're doing that, especially with the US dollar, not only in the US, but all over the world. So that is the big difference between volume in a conventional, in a normal market and volume in a Forex market, because it's unlimited supply, basically. There's no ceiling. And to measure that, well, it's very, very hard to do. So obviously there are a few little tips to try and get a sense of the volume. And essentially that's what we're doing in Forex, is we're not getting an accurate number of the volume of orders. We're getting a sense of the orders which are in place and the activities in place. And there's three different types of volume indicators, which we'll go into. But Dillon, did you have anything to add to that?
Yeah, I think you've touched on a really good point, and it's a really good introduction to this whole thing, because understanding how volume works in Forex compared to other traditional markets where there is a centralized, location, it's very easy to measure. But because there is no centralized location for Forex, you're going through different brokers, different banks, companies making transactions all around the world because of the goods and services that they're selling. It is very difficult to get a gauge on what's happening. Now, I'm probably jumping the gun a little bit, but with an exchange, there is price and then there is volume. Now, price can be arbitraged between all these different banks and institutions, and even between general exchange of money from retail. It all gets arbitraged, and then there's one price. Different exchanges are going to have, of course, discrepancies, but because there is an arbitrage there, the price generally is the same. With volume isn't dependent on what happens around the world. The only thing that matters is if price is consistent. Now, volume can be all around the shop. It could be on one exchange one thing, but a lot different on another exchange. The only thing that matters is price. So price is going to be consistent. Volume might not be. And when it comes to measuring volume on just one exchange, for example, particularly if you're doing back testing or things like that, if you're measuring volume just on one exchange, if you'd measure it on another exchange, it might be completely different. And that's where your trading strategy might be slightly different, depending on where you're actually testing your strategy or actually trading your strategy and the like. So as Judge mentioned, there are tricks and certain nuances that we can do to help consolidate that information as much as possible. But when it comes to volume, it is very different across exchanges and things like that, and it does become difficult. But that's the challenge, of course, with Forex, and we can, of course, do what we can to help reduce that challenge and to actually make it somewhat profitable for us moving forward. So I think that leads us into now what is volume, and what is volume, I guess, for No Nonsense Forex in terms of a signal filter. So, Judge, did you want to talk about volume in terms of a signal filter and why it's important when it comes to its place in our trading strategies as well as No Nonsense Forex trading strategies?
Sure. And I think I wanted to also touch on really quickly what the purpose of volume in No Nonsense Forex is. And the fact that there is actually three different types that VP has mentioned of volume indicator when it comes to Forex. And that primarily is you've got your standard volume indicator, you've got volatility, and how that obviously correlates with volume, and you've got momentum. Momentum is basically the measurement of speed and strength of price movement. So, how fast the candle grows, et cetera, et cetera. And then the indicator gives you an indication in real time. Volatility is the obvious one, how volatile a market currently is, which is what correlates with how liquid it is. You essentially can't have more volatility without there being more volume present in the market. That's the reason why he did an extra video on volatility, because they're not the same, but they're related. But now I want to explain why they're not the same, because the reason they're not the same is volume is the actual measurement of contracts and orders, which, as we touched on before, works perfectly fine if you have a centralized exchange like, the New York Stock Exchange or the ASX, because a stock will have, a bunch of orders to buy and to sell, and it has a limited number of shares. But in the Forex market, and because we're talking about conversions, people can place orders and not fulfill them. People can put orders there just to manipulate and give the impression that there are actual orders sitting there and then cancel them. So when you're measuring volume, the actual indicators that measure true volume on these fixed exchanges where there is a limited number of orders and shares, etc., those indicators behave differently when it comes to Forex. So what they end up doing is they measure the actual measurement of contracts and orders of FX on your particular broker. And depending on how that broker is set up and what they're plugged into when it comes to the open market, it may measure parts or all of whatever their liquidity provider is as well. So you touched on something really, really interesting there, Dillon, as well, when it comes to choosing your broker. And if there is ever a question to answer, although this is a side question, is yes, it does matter what you choose as a broker when you're backtesting. Because if you develop a system on one broker which has a certain level of volume and a certain level of orders going through it, and then you move your system to the MT4 of another broker that you decide to use to trade on, your volume indicators are going to give very, very different, in some instances, very, very different results, which means, you're not going to get the same signals theoretically. A lot will still be the same, but some might not. You might get a signal on one broker and not get a signal on the other. And that is why trade copier software exists out there. But we're not going to go into plugging trade copier software, but certainly that's, if you've ever wondered why people use them, that is the reason why. Is because they built a system on one broker, and volume-related indicators, etc., will display differently on other brokers, and you don't want to have that happening. So that's why they use a master terminal to get all their signals, and they copy those signals over to other terminals that they're trading on. But what is the purpose of volume in no-nonsense Forex? Well, as we were talking about in previous episodes, using the old surfing analogy, which I was talking about, where the larger waves are the trends, EVZ, in this instance, is like the swell, which is essentially the environment. If you're a surfer, you would understand what swell is when it comes to reading the surf. In such case, when you get up and you look at the news and you know that the swell's up, you know that the waves will be big already, because the swell that's coming in is already quite large, meaning the potential for large waves and sets of waves, and in this case, which means trends, is higher than if swell is flat. Then generally the ocean's flat when the swell is flat. So that's where the EVZ part comes in. But VP uses the analogy of air or wind to kind of describe what volume is to us. But basically, volume with no-nonsense Forex, because we're using indicators which are just measuring its presence, I liken it to, it's like wind that affects a tree. So much like wind affects a tree, we can feel the wind, we can see wind when it blows a tree, and you can see the tree moving, but you can't actually see the wind itself. And that's essentially what our volume indicators or volatility or momentum indicators are doing when it comes to Forex. And the no-nonsense Forex method of trading is we're not actually measuring volume itself in the market, because as I said, it can't really be done with Forex. But what we're doing is using indicators which trigger when there is volume in the market, or don't trigger when there's less volume in the market. So how do we apply that to a no-nonsense Forex algorithm? Essentially, this is another filter. So if you've listened to our previous episodes, volume is designed for one purpose. And the purpose of volume is to essentially give us a higher probability of a trend forming. Because as VP had said, when there's volume around, trends tend to happen at a higher probability. So what we're doing is we're taking our C1, C2 filter, and we are filtering it with volume to make sure that there's volume in the market of that, because it gives us a higher probability that trend will then develop to create a mega trend or a larger trend, which is the trends we want to be on. So the purpose is to help us not only make sure that we're getting into a high probability trend, but it's also to help us identify when the market is flat. Well, similar to with the surfing analogy, we want to know when there's no swell around, or we want to know when there's a lower probability of large waves coming. You essentially don't want to be trading when there's low volume. So especially volatility indicators, when you can see that the volume is low, there's really a low chance of large trends forming when there's not too much activity happening in that particular market. The idea of how to apply this is you take your C1 and your C2, and you've got all your win rates. You've already tested it. It's a really, really high win rate. The idea that VP has given us is that you get your volume and you see how many losses it has filtered. But remember, our whole purpose here is to look at the chart first. Make sure that your volume indicator is picking low volume periods, the choppy periods, and it's displaying low volume on the indicator during the choppy periods, and that it's showing, high volume during the trends. That's the first thing you do when you're choosing a volume indicator, is make sure, again, it's fulfilling its purpose. And then once you've done that, you can then compare it to the results and see how it impacts the losses that you have on your C1, C2 combinations.
Judge, you've raised very, very important points. And what I want to emphasize, and something that we did talk about a lot last week, but what I want to emphasize is when it comes to testing your volume indicators, this one's probably one of the most important ones when it comes to testing them from a qualitative aspect. So going back and actually looking at the charts and actually seeing that it's doing what it's meant to be doing. It can also come with its challenges as well, because I know, reflecting on how I used to backtest and trying to find a good volume indicator, is there's not going to be a holy grail volume indicator that will keep you in big trend scenarios and keep you out of choppy scenarios. There's going to be, of course, sometimes you win, sometimes you lose scenarios in that. But what you want to see is, majority of the time, and from a metric standpoint in terms of win rate, you want to see your probability increase and your probability of catching those big trends increasing. So as Judge mentioned, you want to be taking out the trades where there is choppy market conditions, and you want to be keeping the ones where there's trending market conditions. Now, I think when it comes to adding a volume indicator, this is where you'll see the biggest change in terms of metrics, in my opinion and from my experience. Because when adding a volume indicator, it is far different than all the other indicators that you have in your trading algorithm, and if you're following No Nonsense Forex, in the No Nonsense Forex trading algorithm. Because the volume indicator, of course, measures volume or volatility or the like, but your other indicators might not necessarily be measuring volume. Majority of the time, they're only measuring price. So when it comes to what you see on the chart, there's two things. There's price, open, high, low, close, and then there is volume. So how many shares, or I should say currency, how much money is traded at a given time. So there's two things. Majority of indicators predominantly measure price. You do have, a combination, but majority of indicators do measure price. And that's why when we are collecting our indicators, we have a collection of, trend following indicators more than volatility or volume indicators, because there's more trend following indicators out there, I guess. So when it comes to measuring your indicator, you need to understand what's happening in the background, because there's two types of different ways these could be done. There could be strictly volume indicators, which just measure volume, and it will just tell you when there is volume and when there isn't volume. And this might not necessarily be directional. So you need to make sure that you understand what your indicator is doing, because if your volume indicator is not telling you whether the trend is high volume long or high volume short, you need to understand the difference there. But if your indicator does tell you direction, then it would be combined with price. Now, there's no right or wrong way to do it, but you just need to understand the differences there. And it doesn't matter whether you have a volume indicator that is directional or not, because your algorithm will already have trend following indicators in there anyway. So when it comes to finding a volume indicator, it doesn't have to be directional, but you do need to understand the differences between them. Judge, is there anything else you want to talk about in terms of volume?
I just wanted to say I completely agree with everything that you have just said. Like, it's not about having a specific type or characteristic in an indicator. As you mentioned, Dillon, there are volume indicators out there which are actually volatility indicators. They're the ones which tend to be the directional ones, because volatility is measured in a direction. Something's more volatile long or volatile short, it'll display in such a way which is pretty much very similar to some of the confirmation indicators that we have out there.
Yeah,
but
that's right.
then, as I mentioned, with the 3 different types of volume indicators out there, none of them will apply directly to Forex, with its original purpose, because as I said, it's not a stock market, it's not limited, it's not a centralized exchange. So if you pick up a true volume indicator, not a volatility one, which is telling you the direction or how strong a direction of a trend is, which is what volatility does. If you pick up a true volume one, it's going to be measuring the metrics of the orders on your broker. And if your broker is huge and it's a big one and it's global, and they have their own liquidity and exchanges around the world, then they're probably going to have a lot of people on there, and will represent a large portion of what's happening around the world. So ideally, the last thing to add about all this is these volume indicators, they're not going to give you true volume. They're going to give you, like I said, like the analogy of the wind. When the wind is affecting the tree, the wind is there. You can't physically see the wind, though. And that's how these indicators will work, is we can see when there was volume in the market, but these indicators aren't actually showing us true volume. They're just showing us when it's present. And that's my last thoughts on that, I suppose, before we segue into the one candle rule.
I really like that analogy, Judge, the wind, because when it comes to assessing volume at different locations, for example, because, of different banks or on different exchanges, the wind can be blowing in one direction, but it could be calm, in a completely opposite side of the world. And that's where there is differences in volume and the like, depending on the exchange that you're using. And I think, Judge, you mentioned if you're using a big broker, even just a large broker to backtest or to copy your trades from, maybe that might be the safest bet, is to find something that tries to encapsulate majority of what's happening, because that will give you a bit more confidence that that's the true volume. If you're backtesting, for example, on a small broker, that might be the broker that you might be using, but it might be relatively small volume. Prices are generally the same because it gets arbitraged between everything. So prices are generally the same. As I mentioned, volume might be a little bit different. So it's just something that you have to be aware of when it comes to testing or even trading. And maybe it is something that you might need to consider and have some sort of copy trader there. But the one candle rule. So, of course, the second part of this podcast, as I mentioned, was the one candle rule. Now, I mentioned just when this started, me and Judge, we spoke yesterday, just in preparation of this podcast. And I was talking to Judge about the one candle rule. And then Judge was like, Dylan, wait a minute. There's something that you need to go back and just check on. And this is a very common thing that gets maybe forgotten about. There is a no-nonsense Forex way of using the one candle rule, and unfortunately a lot of people have used it wrong. And when I went back to watch the one candle rule podcast, I should say from VP, there is a little bit of a nuance in there that I did miss. Now, I did go back and test it out and everything like that. But it's important to realize that the one candle rule coming from No Nonsense Forex, I guess, is traded the No Nonsense Forex way. Now, of course, you can put your own spin to it and you can make your nuance your own. You're not forced to trade it strictly No Nonsense Forex. But I think this is where this podcast becomes very valuable. And that's to shed some light on things like this, on questions, very common questions, or maybe misconceptions that there are out of the community. Because, Judge, I know your experience dealing with a lot of people in the community, this is something that gets picked up quite a lot. And I think you mentioned to me yesterday, only 10% of people do it the right way. So, Judge, did you want to talk about the no-nonsense Forex way of using the one candle rule?
This is actually a nuance. But when it first came out in VP's, in his series, it was called a rule. And a lot of people just adopted it blindly. But if you once you consume everything and then you go back and look at it in context and in hindsight, you realize that it really is a nuance. And this actually came to me when I did the backtesting competition, because I coded up 35 algorithms from people in the community, and about half of them had the one candle rule in them. So not everyone is using it, because and that's a good thing, because it's a nuance. It's very nuanced, and it doesn't work for everyone, and that's okay. Of the people that were using it, only 10% were using it the way that VP had intended. And when I say that, I mean, a lot of people don't realize that it's not just another entry. It's not just to give you another way to get in the market, because that would be incredibly FOMO of us to do that. Thinking of a way that, we've just put in this volume indicator to filter our C1. Let's think of a way to remove the filter. That's not what it's for. The purpose of it is and VP has explained this, and if you go back over the podcast that he released, it will explain this. Yeah, it's definitely there, because I think Dillon didn't realise it was there when I was saying it to him. I got the impression you were like, "What are you talking about, dude?" And then you went back and it was there. But the key to remember is, and I shorten it and I just say, the one candle rule is you have to wait. You give your algorithm one candle to allow volume to catch up to your C1, with one condition that is tacked onto the end. There must be a pullback of price. Now, VP doesn't say the word pullback. Actually, I think he does say the word pullback.
He does.
He hadn't done the pullback video yet, or explained what a pullback was in the series. So he kind of tried to just describe what a pullback is, rather than just call it a pullback. But essentially, you can wait one candle for your volume to catch up, all right, and to all your other indicators. On the proviso, all your indicators still agree one candle later, but price must, and this is what VP said, price must be the same as what it was when you first got the signal, or better, which basically means a pullback. It essentially means price needs to be not have run any further than when the original signal is, which is a pullback. So if you throw that in and you tack that on to the end of your own one candle rule, you'll find that it will pretty much hardly ever happen. I mean, for me, on my algorithm, it happened maybe once every 2 pairs in a 3-year period. So it should, for me, it added on a total of 20 trades over a whole entire 28 pair back test over 3 years. So it doesn't happen very often at all. And VP has actually come into the Discord and re-clarified that some time back. He basically said it hardly ever happens. It's a nuance. So if you are one of these people that's like, one candle rule, I just follow what VP told me, and I just, if my volume doesn't agree, but it agrees one candle later, I'm entering, then you aren't doing it the no-nonsense way. You're missing the point. So people ask me, well, why did VP create this nuance? Well, why is it there if it hardly ever happens? And if you have a little bit of experience building algorithms, you'll realize that sometimes after periods of low volume for a long time, like dead markets like now, when the market finally starts trending again, volume indicators are the one indicator that are the laggiest. They're slow to respond.
Yep.
And the last thing you want to do is miss the trend because your volume indicator said no when it was actually just wrong because it was still readjusting. That is the reason why on VP's algorithm, he found that if he waited one candle on those big trends, when he'd missed those big trends, that if prices pulled back, he was able to pick up that trend. And so the purpose behind the one candle rule was a nuance for his specific algorithm to get into trends that he had missed because of laggy indicators. And that's the purpose of this nuance. You hear VP talk about it all the time. It's like, he doesn't care about losses, but he cares about it when he misses big trends because that's his money, that's the profit, right? So this is a nuance specifically created for his speed of algorithm for when his indicators take a little bit to catch up so that he doesn't miss trends. It's not to give him extra entries and extra ROI or anything like that. It's to deal with the problem that he was looking at on the chart. And I suppose that's why we wanted to talk about it with volume, because it is related to his volume indicator. But that doesn't mean it can't, the one candle rule can't relate to your C2 indicator or any other filter. But just remember, it's all about the purpose of why you add a nuance, the purpose of why you're adding an indicator is you need to look at the chart and you need to look at, how did I miss that trend? What can I do when it comes to a nuance to make sure that if that happens again, I can be in that trend? And then you come up with an idea, like what VP did with the one candle rule, and you go, oh, okay, well, I'll test that idea and see if that actually works and actually fulfills the purpose. So that is essentially the one candle rule. You have to have the pullback. If you don't have the pullback, then it's not the true one candle rule.
Judge, it's a very interesting topic, this one. I did go back last night and actually tested this out. And I know, Judge, you mentioned for your trading strategy, it doesn't happen a lot. So I did test the one candle rule, the no nonsense Forex way, and then I did test, and I should say the no nonsense Forex way, including the pullback. And then I did test the one candle rule, I guess the other way, which doesn't include the pullback. And it was very interesting because you're absolutely right. It is a nuance and something that doesn't happen a lot of the time. Now, for my particular trading strategy, I tested this for all 28 pairs over 10 years. And when including a condition that you have to get a pullback, this one candle rule only happened 10 times. 10 times out of 10 years for all 28 pairs. It's something that rarely happens. Now, if you take that condition off and just trade the one candle rule, but you're not putting an element of pullback in there required, this will increase the amount of trades that you have, what I saw, by about 40%. So you're increasing the amount of trades you're getting because you're adding that additional trigger in there. And then you're right, Judge, it goes, it makes you think about, what is the purpose of this one candle rule and why is it in there? And what is the reason of it from a qualitative standpoint? Because as we've mentioned and we've harped on about, is you need to understand what your trading algorithm is doing, not only from a metric standpoint or a quantitative standpoint, but actually its real purpose. Now, Judge, you raised a really valuable point that if you're adding another trigger in there or another reason for your trading algorithm to actually enter a trade, and then undoing what you have done in terms of your C1 indicator and your volume indicator, then it does go away from the original premise of why you're putting all these different pieces together. So it is a very interesting point and something that I'm going to explore a little bit more, because
I'm sorry, Dillon. I'm sorry for adding all this extra workload to you now.
No, and that's the whole reason behind, this podcast, and of course being, no nonsense Forex related. If there's any clarity and anything like that, then of course it's very valuable that we do this, and that's why I appreciate Judge, of course, being a co-host here because of the amount of value that he has in No Nonsense Forex and being a part of the community. I think this isn't going to be the only time that one of these situations do come up, and that's why I do appreciate Judge, you being on the show, isn't it? Yeah,
it's a bit of a bomb. So I just wanted to clarify.
That's right. Exactly.
That I don't actually use one candle rule, and the reason for that is because my algorithm is too fast. And what I've noticed, and this may be the case for majority of people, it certainly was in all the ones that all the backtest competition algorithms that I found and that I coded, was that the faster the algorithm, the less effective one candle rule is. Why? It's because your indicators are less laggy, so you don't need it.
Yeah, that's right. Yeah, it's something that, as I mentioned, I'm definitely going to look into more because at the moment, of course, the one candle rule that I have isn't the no nonsense Forex one candle rule. And this is where you don't have to have a one candle rule. You don't have to have, everything of the no nonsense Forex trading strategy. And as well as that, you can add your own twist to a lot of these other things in your trading algorithm. You're not forced to do strictly no-nonsense Forex. You can take elements of it, and that's where, as I mentioned, or we've mentioned before, you can really make these your own, and you can really develop your own nuances or your own rules, or you might find, when backtesting, your own little nuance there or your own edge that you might want to exploit out of the market. But saying that, as long as your trading strategy makes sense to you, both from a qualitative standpoint and a quantitative standpoint, of course, when it comes to measuring your metrics, whether it be volume indicator or whether it be your one candle rule, are you increasing your win rate? And if you have money management in there, are you increasing your profitability and your profit factor? Are you getting into those trades, those big trending trades? And you have to look back at the charts and go back and assess what your trading strategy is doing by looking at the charts, but also from a metrics point of view. You have to do both. And if it makes sense to you, then that's awesome. You might have a trading strategy that looks very promising and looks very profitable as long as it makes sense. So, Judge, we've gone on a little bit, actually. I know we're meant to be keeping these relatively short, but saying that, I just want to mention just everybody that is listening live. I do appreciate all of you for sitting in and sticking around. It's been amazing. Judge, question time, I think, if we got a little bit of time of that. Rapid fire question time. Done. I know Solution Mania has one that I did see. And the question from Solution Mania was, I've seen quite a lot of people talk about using two volume indicators. Just because you haven't found the right volume indicator, should you be using two in your algorithm? So is it perfectly acceptable to be using two volume indicators? Is it useful? And should we be using it? So from my perspective, and I know we spoke about this one, Judge, you can make this strategy your own, and you can really put, what you like within your no-nonsense Forex algorithm. And if you find that incorporating two volume indicators or a volume and a volatility or, anything like that, if you find that that is beneficial to your trading strategy, then I think there's nothing wrong with it. Judge, would you have the same opinion?
I agree. I would also go one step further and say that if it works, why would you want to change it? Just have it as your normal. Ultimately, it's two indicators, but all it takes is $5 and you can go get it coded into one. So then it's one indicator. So at the end of the day, if it works, if it's filtering and it's keeping you out of those low volume periods and the two of them are working well together, then, hey, why change it at all? Just keep it.
Exactly. Agree. Judge, do you have a question from the chat, if any?
So we've got a couple from Shark Punch, which are sitting in the live show channel currently. I'm not going to go through all of them because I think we covered some of it. He's got what are the advantages, disadvantages of using tick volume? Does this make distinction between volume and volatility indicators? We pretty much covered that in the sense that tick volume is, again, just measuring what's on your broker, because the ticks are created by the platform that you're on. And essentially it is on your broker, but ticks are essentially the measurement of movement of price. And because price is global, every broker should be counting the same number of ticks, but latency and there's technology involved here, people. So sometimes, what one broker has when it comes to ticks recorded and the price movement will be different. And it can be manipulated too. So the advantages, just treat it like a normal volatility indicator, just understanding that obviously when there's lots more volume, there's going to be lots more tick volume. When there's not much volume in the market, then there won't be as many ticks recorded. That's basically that one. And I guess, Shark Punch, you've gone into the question, what are the advantages, disadvantages of using directional volume indies, which is, in my opinion, volatility. That function almost like a C3. But yeah, essentially, I think you're talking about, like what are ATAR explosion, which is an indicator. No, I'm not shilling indicators in here, but everyone knows about that indicator as a volume indicator. It's been around for a long time and it's all over the Discord, and there's so many different versions of it. But essentially, that is based on Bollinger Bands, which is putting that into it basically displays itself like a histogram where you can see it rising and falling in both directions, long and short. But ultimately, what you want to find there is the dead zone when it comes to volume, because obviously every single one of them is going to display differently, and depending on your broker as well. But what you're looking at, if you're looking at the chart and you're using any directional volume, try and look for a dead zone, because dead zones generally mean anything underneath that particular line, which is your dead zone, will generally be really low volume periods. Where you place that dead zone, for me, a lot of the time was qualitatively. I look at the chart and I have a look at where the dead zone should be to filter out most dead zones on the chart, for lack of a better term. But yeah, then when it comes to direction, I don't use them as like a third confirmation indicator. I'm using it for volume only. So when I get a directional volume indicator, it's for finding dead zones. I kind of look at it backwards. I look for the dead zones and I make sure my volume indicator is saying this is a dead zone. Because obviously with any trend, there's always going to be volume. Every volume indicator is going to say there's volume when there's a trend. Because you're trying to eliminate losses caused from false signals from your C1. Look at the indicator and make sure that it's aligning with dead zones, and that's it in a nutshell.
I think, Judge, you raised a very valuable point, and something that is visible on the ATAR explosion, the WAE, but something that's important nonetheless for every single volume indicator that you do use. And something that we want to stress is, particularly when looking for the right volume indicator, I think it is more or less a qualitative approach when trying to find the right volume indicator, and that is finding one that gets you out of those dead zones. And those dead zones are the ones where the market is really not moving at all. There's a lot of chop and it's just not doing anything. And there is a difference between chop and mean reversion, and mean reversion just has, a pullback which has volume. Chop is when there's just market noise and it's not really doing anything, and there is a little bit of an opportunity cost there for being in that trade when there is a choppy situation and you see one is just going all over the shop, whipsawing around, and it's giving you signals all the time. Now, this is where, as I mentioned before, your volume indicator is so important and would have, in my opinion, one of the biggest impacts to your trading strategy, and why it's probably, in my opinion, the backbone of your trading strategy, and why, other than the C1, I should say, it's second to the C1, but it's so important to have a very good volume indicator to get you out of those choppy situations.
Let's face it, like if you use one of those volatility indicators and you have a dead zone on it, go and find a trend that is in the dead zone. They don't exist. You're not going to have a trend in a dead zone. So, that's the most important part of those volatility indicators is, tuning that dead zone.
That's right. So, Judge, I think that is it for today. Once again, we appreciate all of you for tuning in. For those that are tuning in live, very grateful, because I know we had a few people write in, as well as a little bit of a conversation going between those listening in too. So for those tuning in live, particularly for the whole live stream as well, for some of you, definitely appreciate all of you tuning in. Saying that, of course, Judge as well. So we'd appreciate, of course, for all of you that do like the content that we are providing and might be of benefit maybe to other no-nonsense Forex traders, or even other traders that, might not be, I guess, strictly no-nonsense Forex, but, some of the content that we might be providing might be, of course, beneficial to them. Of course, we'd appreciate if you would be able to share the videos and things like that to all of your other communities. Of course, really greatly appreciate it, because
I think it's a reach out.
Helps
it's
us.
a reach out we want. We're hoping you guys can. So obviously, this is our 5th episode, right, Dillon? And episode 4 of the series.
Yeah,
but it's the 5th episode.
Fifth podcast. Yeah.
Yeah, but what we're hoping for is, obviously, we're getting a really nice following, really good questions coming in, and we're getting some great content and great discussions now happening here in the No Nonsense Forex Discord. But what we really would like is to help, ultimately, as many no-nonsense Forex traders, which may have, all the similar type questions, similar type thoughts on no-nonsense Forex. It's quite common when you look back over the Discord at all the questions from new people as well as old people who have been around for a while. There's always common themes and common gaps and common thoughts that come from VP's content. And I suppose, that is one of the primary things that we're trying to do with this podcast, is just to clarify some of those gaps and to help people look at it just at a little bit different angle, which can hopefully spark some creative ideas and hopefully help everyone's trading when they're doing the No-Nonsense Forex way. But we appreciate that not everyone is in the No-Nonsense Forex Discord, or they're here, but they're not, they're not tuning
active
in.
Yeah.
So if you're able to, if you like this content or you feel that it's helped you in any way, feel free to share it in other communities, where it's on Facebook, Twitter, Instagram, or what are all these social media things? Just wherever it is. Just help people understand and know that we have this thing happening every week to help no-nonsense Forex traders. So if they don't know about it, or they're not in the Discord, the No-Nonsense Forex Discord, that way at least they know they can neutrally listen in and tune into it on YouTube. If you could, that would be fantastic, guys. And I think, Dillon, we're wrapping it up.
That's it.
I'm done.
Again, really appreciate you all listening in today. And with that being said, super grateful as always. And we will see you in the next episode. Happy trading, everyone.
Happy trading.